Trustee Jardy, would you like to lead us in the Pledge of Allegiance? To the flag, United States of America, to the republic for which it stands, one nation, God, indivisible, with liberty and justice. Okay, the Mendocino County Board of Retirement meeting for April 17th, 2024 is called to order at 8:30 a.m. Judy, what did I say?
May
Okay,
15th.
so I have that on my annotated.
Oh, sorry.
Yes, correction, May 15th at 8:30 a.m. And Judy, would you please do the roll call for us?
Yes. Mr. Kelly? Cavanis?
Here?
Mr. Jardy?
Here.
Mr. Cromer?
Here.
Your maker will be absent today. Ms. Harris?
Here.
Mr. Swope? Absent. Ms. Pierce?
Here.
Mr. Land?
Here.
Thank you.
Okay, first we have the consent agenda, and members of the public are welcome to address the board on subjects both on and off the agenda. Do we have any members of the public wishing to make comments at this time?
There is no public comment.
All matters of the consent agenda are to be approved by one action without discussion unless a board member requests separate action on a specific item. Does any trustee wish to pull an item from the consent agenda for discussion? If no, the consent agenda is approved by unanimous consent. Okay. Discussion regarding the historical benefit review project status report and project updates. Presenter, Director.
Thank you, Chair Cavanis and members of the board. We've been making some slow but steady progress. During the month of May, we had 4 corrections completed. That leaves about 55, I believe, that do not have a purchase or DRO issue that we're waiting on the IRS to confirm the new correction methodology that are outstanding and would still need to be corrected. So if you have any questions regarding the report, I'm happy to answer any questions.
Do we have any board member discussion on the item? Is there any
Madam Chair?
Yes.
I'm sorry, did you give a number of the remaining? If you did, I didn't catch it.
There's about 55, I want to say, that do not have a purchase or DRO issue. The purchase and DRO issues are probably about 200, but most of those are, we can't do anything on until such time as we get direction from the IRS.
Thank you.
Is there any public comment? Seeing none, we'll move on to investment matters. Presenter, Mr. Rivales, Mr. DeForest, and from Callan. Okay.
Chair, if I may, the first item under investments is the memo from Trustee Jardy regarding recommendations on the portfolio. Then we have a follow-up item to that from staff before we get into the Callan presentations.
Thank you.
Okay, so Chair, if I may. So I want to thank the board for taking time to discuss these items. I think that the portfolio that we have is probably the most important work that we have in front of us as board members. But in context, I also want to acknowledge that I think when I look at all the boards I've served on, which are pretty wide variety, nonprofits, government agencies. I think this board is probably has some of the more complicated issues in front of it. And I want to acknowledge the fact that none of you are getting paid to be on this board. You're either community members volunteering or it's an extra assignment you've taken on as a county employee. You know, you weren't hired by the county, if you are a county employee, to serve on this board. This is just an extra assignment. And yet what's asked of us as board members is quite a bit. Like I said, I think it's more than what I've seen of any other board that I'm on. And so I want to acknowledge that up front. In part because of that, I personally have felt over the years that I've been on this board that I've felt uncomfortable with our investment portfolio for a couple different reasons. Principally, I've never felt that I've had enough information about the investment funds that we're investing in. If we were invested in broad indexes, like the total US stock market, the total international stock market, I wouldn't have to worry that are we outperforming the average, because we would be getting the average. But instead, prior to any of us serving on this board, our predecessors went with actively managed funds. So they were placing a bet that they could beat the average, that they could find the best funds out there that were going to beat the average. Well, what have we learned over the last couple decades? We've learned that managers might beat the average for 5, 8, 10 years, maybe even. But to beat the average over decades, over long periods of time, it's incredibly unlikely. And what we've also learned, although I don't hear it discussed at these meetings by our consultants, is that oftentimes the way an active manager can beat the average is by taking risks. And so what they end up doing is, even those that do beat the averages, they almost always are much more volatile in achieving beating that benchmark. And so when we talk about our portfolio, we need to think about, do we have the information we need to make those brilliant decisions, to find those very best active managers that are going to beat the benchmark? And I would say there's no way that we've been given enough information to make that decision. I think there's good reason why I've been uncomfortable with our decisions to keep the funds that we've kept. When I've asked staff for the tickers, which is kind of the shorthand for the funds that we have, which isn't routinely provided to this board or the public, then I go to the number one benchmark out there of comparing funds, and that's Morningstar, which I've personally subscribed to now for about 2 years. And when I go to them, I see that we're kind of all over the map. Of our 10 actively managed funds, 6 are reviewed by Morningstar because 6 have tickers. And of those, only 1 is rated gold of the stock funds. 3 are rated silver, 2 are rated either bronze or neutral. 4 aren't even rated. Now, I understand that Morningstar has a subscription that's available for institutions that I don't personally pay for, but MSERA staff could pay for. It could be in our budget, which might review those other funds. But the point is that when we do get information about these funds, we're not really given the information that I think is needed by this board. We're shown by Callan a 5-year look back of the volatility, what is called standard deviation. We're not shown a 10-year look back, we're only shown 5-year look back. So I've had to reconstruct by looking at old reports to show the 10-year look back of the standard deviation. See hand raised for Mr. Holt.
Yes, I would like to have just a brief elaboration on what the metric is for gold, silver, and bronze for Morningstar.
Okay, so Morningstar, again, it's a private company, but it's grown quite a bit. So it's by my understanding, it's the industry leader in reviewing mutual funds. They do review some large corporations like Berkshire Hathaway, Apple, et cetera. So they have a number of categories. I could pull it up, but they have a number of categories. Generally speaking, they look at the process by which a fund, a mutual fund is selecting companies. They look at the people that are managing that fund. That's the one category I hear Callan talk about, is the managers, but that's only one of the pieces that Morningstar uses. So they use process, people, parent company are the principal 3 areas that they look at, and you have to score well in all of those to be rated gold. What I see, and it's on our agenda later today, Callan talks about the people, but that's only 1 out of 3 general categories that Morningstar is looking at. And the other thing that Morningstar talks about is risk reward. I don't hear Callan ever talking about that. Risk reward, and I'm going to use very general descriptions. If you had a mutual fund that was beating its benchmark, let's just pick something randomly like small cap value. And let's say that it outperformed the small cap value index by 10%. But if its standard deviation, its volatility, its pathway to get there was 20% higher than the index, that would probably score kind of low on risk reward. We never hear that analysis from Callan. That is inherent in the analysis that Morningstar has for all their funds, because some investors are fine. Maybe it's a portion of their portfolio that they're going to not look at. They don't really care if it's really volatile. But that's not the way we treat our fund. We look at it holistically, at least supposedly we do. So anyway, so I just wanted to say that as background as to why I wrote this memo. And so again, we have what we've seen is we have random performance from these active funds, but what is not random is they are more volatile than the index, and so they're introducing an extra 6% of volatility to our entire portfolio, which is not entirely equities, but just the equities portion of our fund is adding 6% volatility over what we would have had we just had the index of the international and the US. So in exchange for that extra 6% volatility, what are we getting? We're getting random performance. Sometimes we barely beat the index, and other times we underperform. So we're taking on extra risk without any probability of beating the benchmark. And so the risk reward is we're taking on more risk and not getting the reward. So that's why I'm saying, given the context of everything this board is being asked to do, if for no other reason, just go to the index so we don't have to have that burden of knowing that we found the very, very best actively managed funds. Because again, when we look more deeply, we don't have the very best. And we're not outperforming, but we are introducing extra volatility. And then let's look at the components of what makes up our portfolio. So it's US stocks, it's international stocks, it's diversifiers, I'm going to call them defensive, that outperform bonds, which is real estate, and we've added infrastructure. And then, of course, we have bonds. So just going through the list, we have real estate. So we have 2 real estate funds. I think these funds predate all of us on this board. I don't remember when they were added. But one fund, comes close to meeting the Vanguard real estate index fund. I understand that owning publicly traded real estate stock is not the same thing as being a private investor in a private fund, which is what we have. We have investments in 2 private funds. But let's look at the difference. There are tens of thousands, I'm not going to say millions, there could be, but there's definitely tens of thousands of Americans who invest in the Vanguard Real Estate Index Fund. It's many hundreds of companies. These are publicly traded companies. Why do people invest in that as a part of their portfolio? Well, it's because real estate as a publicly traded equity is underrepresented in the US stock market in this sense. The vast majority of real estate in the United States is privately held. To a greater extent, the real estate of America is under private ownership than corporations, just generally speaking. And so some people will say, therefore, I want to tilt my total stock market, US and international, a little bit towards real estate. Also, it does perform slightly differently than the entire total stock market, whether it's US or international. And so that's why some people do invest, do put a portion of their portfolio in the Vanguard Real Estate Index. I'm not saying it's the exact same thing as our private real estate investment, but I am using it here for illustration purposes. Well, how well are our real estate private investments doing? They're underperforming what we could get for at almost no cost, the Vanguard Index. And so I'm not proposing to switch to it, but I am proposing to at least compare how are we doing by how is the Vanguard Index Fund doing. And secondly, but when we look at the 2 funds, even the benchmark that Callan gives us for real estate, we have one fund that's substantially underperforming their own benchmark for real estate. And I think we need to have it on a watch list. And we need to say, hey, maybe we aren't happy with getting 2% less than the benchmark for this real estate fund. That it's hurting our fund, our total portfolio. Secondly, I then go into saying, well, what are some other defensive moves out there? We added infrastructure recently, which seems promising, and it seems to be outperforming our real estate. Another defensive move that many investors use is they do invest in healthcare. They're not trying to equal the U.S. stock market. They're not trying to equal, although in recent years they've been beating the international. But what they are trying to do with the healthcare is they're saying, hey, this is a defensive move. Sometimes, and I showed an illustration here of the number of times in the last, I think it was about 12 years, I think it's 7 times out of those 12 years that healthcare outperformed the international and U.S. stock market by more than 5%. Oftentimes it didn't drop when they dropped. So healthcare's, I wouldn't put 100% of portfolio in healthcare. I wouldn't put 100% in anything. But it's worthy of consideration, and there are American investors who put money in healthcare as a defensive move. And it would substantially boost our defensive sleeve if we had it in there, and it would add extra diversification. And then finally, on our asset allocation, why can't we have more money in equities and in our defensive moves and not in the defensive move called bonds? Why? Callan had given us 5 mixes. Mix 5, they said, was acceptable. And so I've shown how much more money this fund would have had we had Mix 5 with these other minor tweaks to our portfolio since January 1st, 2019. When we look at the cash flows into this plan, the people of Mendocino County have dramatically increased their contribution to this plan. We've gone from $8 million a year to $30 million a year. That's from the taxpayers. The employees have gone from 6 to 8.5. What does that mean to the plan? Well, every portfolio needs to be constructed based on the needs of the plan. So if you were a retired member of the public and you didn't have a public pension but you had Social Security, you hopefully have a 401k of some kind that you've nested away during your working years. But that might be all you have other than Social Security. So you would have Social Security as a guaranteed income, and you would have your 401k as an income source. And in that case, you would probably want a fairly high allocation to the safest investments you could find, whether they're a combination of bonds, perhaps healthcare, perhaps some real estate, and others, but other stocks to earn more than inflation. But we're not an individual. We've got this huge cash flow now coming into the plan. The demands of this plan are only around, since 2019, have never exceeded $8.1 million a year. Sometimes it's been less, but never more than $8.1 million. Okay, I got it from the audit, from our reports. And
I don't believe that figure to be correct.
okay, got it from Robert, got it from the reports. So,
it's definitely not correct. We haven't really talked about that in depth. There's sort of 2 ways to measure that. I sort of let Trustee Jurdy get through his comments and discussion before I have anything.
So we have a very tiny cash flow required from the plan. We're not requiring 80% as a retiree. We're not looking at like 80% of our income drawing down from our 401k portfolio and 20% coming from Social Security or something like that. We have a very small percentage of our portfolio that needs to come out. An endowment, a forever fund, say Community Foundation be a local example, they might be looking at a withdrawal rate of 2.5%, 3.5% from an endowment fund, and the fund would be expected to grow beyond that each year. So the fund would continue to grow each year, but they would have money to distribute each year. We're nowhere near those kind of ratios in terms of drawdown. For all those reasons, we could have only 15% of our money in bonds. Again, we don't have just bonds as a defensive move. We have real estate, we have infrastructure. And as you look at Mix 5, Mix 5 shows that we would have more money allocated to real estate and to infrastructure. So what is the net effect of that? Thanks to sources like Portfolio Visualizer, we can see what's the performance. And had we had these different, I would say minor amendments and improvements to our portfolio, removing the low-performing Barings fund, a real estate fund, which has been underperforming the benchmark that Callan gives us, which is underperforming the Vanguard Real Estate Index. Had we just had, and I know you can't go back in time, but had we at least equaled the Vanguard Real Estate Index Fund, which I think we can equal that or better it with our infrastructure and our REEF Real Estate Fund, if we drop Barings. Had we had that little tiny sliver of money allocated in our defensive sleeve from Barings and switched over to healthcare, we would have millions of dollars more in our funds since January 1st, 2019. And, well, what does it mean? That's in 5 years and 4 months. In 5 years and 4 months, we would have about $41 million more in our fund right now. By my estimate, we would be at about 78% funded. I believe, you know, it's just a guess at what our current liability is because it gets published once a year. But I believe at $692 million, we're probably right around 74% funded. And again, we could be at around 78% funded just in a 5-year, 4-month period. So I don't think that today's discussion is going to end the discussion that this board has and the community has about this. I think there's no way our current system of selecting active stocks, there's no way that our mix of investments are going to outperform what I'm proposing here today. And I think over time, members of this board, current members, future members of this board are going to recognize that that there need to be some changes to our portfolio, that in some ways it needs to be simplified, and there needs to be a higher expectation from the funds that we invest in. And we can't just hear from Callan about, as we have a later agenda item, where we only hear about the managers. We need to hear about the risk reward of these funds that we're investing in. How much volatility are they adding to the fund in exchange for the performance they're providing? It's not, and is this board given the information that it needs? Simple reforms for this board to have. We should all have a subscription to Morningstar so we get, you know, a better context of how to invest than we're getting from these, I would say, fairly simplistic presentations from Callan. We should also have an annual disclosure from Callan like we have in today's agenda, so future board members know that Callan is actually getting paid by some of the very funds that we're investing in. And future boards can make the decision, is that the way they want to go? We heard today for the first time that about half of the major companies that consult with pension funds don't get paid by both the pension plan and the outside funds that they invest in. Callan's in that half that does. So I see today's discussion as being healthy. I think it's healthy for this board to have a better understanding of how our fund is performing, and is our portfolio of funds the best investment that we can make. And I say that knowing that this board is being asked to do an awful lot on many fronts, and this is just one of many subjects at this front of this board. And I'll just conclude, what does it all mean? What does it mean if we improve our performance of our fund? Well, for the public, for county employees, what it means is the sooner this fund is fully funded, the sooner the county's contribution to this plan goes down dramatically. Today, about 20 of the $30 million that the county is putting into the plan is to pay off unfunded liability. That entirely goes away when this plan is fully funded. So if you think about the difference that the public would see and that the employees would see, if something like in today's dollars, the contribution to this plan was $10 million a year in today's dollars instead of $30 million in today's dollars, that is a dramatic change to the public of Mendocino County and to the employees. And so the sooner we get there, and these reforms would get us there sooner, the better for everyone. So happy to answer any questions. I'd be happy to hear what Callan has to say and what Robert has to say, but there's no doubt in my mind that these changes would get us to full funding sooner.
You referenced the increase in the contribution rate, and I thought valuable to give some historical context. So I went back in the last 5 valuation studies and detected or determined the highest contribution increase factor. In the most recent, there was a 3.3% change, with the actuarial assumptions contributing 3.7% difference. The 2022 ending was a difference of 1.45%, the effect of higher than expected COLA increases. The study ending in 21 was a negative 3.3% with the effect of higher investment return, with the effect of investment return higher than expected, which was negative 1.79. The ending in 20, it was a delta of 3.44% with the effect of assumption changes comprising the 2.71%. And finally, the 19 valuation study of a delta of 0.43% with the effect of individual salary increases higher than expected. So I wanted to just provide a little historical context for some of the layers that were added.
So absolutely, those are cause and effect, but the net effect is because the fund is not more than fully funded, there's no margin for error. So when there's a new cause of unfunded liability, whether it's salaries being raised faster than anticipated, or people living longer than anticipated by the actuarials, or the fund underperforming, any of those things can trigger unfunded liability. And every time there's new unfunded liability, if there's no margin for error, if the fund is less than a fully funded, it will inevitably trigger a higher contribution rate. My point is, if we have a higher performing portfolio and we get to full funding sooner rather than later, there won't be a need necessarily to every time we have a new bump in the road with something new that creates an unfunded liability, there won't always be a need to raise rates, the contribution rates, because there will be enough of a cushion in the retirement fund. And I foresee a situation if we have a higher performing portfolio, we would have achieved full funding sooner than we're on track to today. And at that point, the board, the public, everybody would be confident that they could have a higher assumed rate of return than 6.5. At that point, they probably would have experienced an actual return rate of maybe 7 or more %. And at that point, the public, the retirement board, would be comfortable having experienced a much higher return rate of sticking with a higher return rate going forward. I'm not proposing lowering the return rate right now. I think we need to develop a track record, but the truth is, if we have a long history of have a higher return rate, this board and everybody would be and we were fully funded, this board would be comfortable with a higher return rate going forward at that point.
So we did see at the March meeting in the Siegel risk report that the changes in employer contribution rates over the last decade that Trustee Jurdy is referring to are actually related to assumption change, and that they're not related to investment experience at all. In fact, the investment experience has been additive to the UA. So, I think it's a little disingenuous to not mention that fact, the fact that the UAL hasn't been paid off or paid down since 2012 Restart Layer started. Now, that's unfortunate, and it helped the county over the last decade, but that's where we are today. And so the track record really is that the change in contribution rates have not been driven by investment performance. They've been driven predominantly through assumption changes over time.
So in this month's meeting packet, we have the quarterly report from Callan. It shows our total portfolio earned 7.04, so essentially 7% over the last trailing 10 years ending March 31st of this year, 7%. During much of that 10-year period, our predecessors on this board, we had an assumed rate return of more than 7%. Some of that time it was 7%, then it was 6 3/4, and now it's 6.5.
Trustee Cromer?
I just wanted to make one comment about what Mr. Revelis had said, and it was a note that I had written down. This board, historically, for some members that have been on the board longer than I and some that are newer, did make conscious, deliberate recommendations to the Board of Supervisors in recent years to pay down the UAAL faster, which removed 2 years off that layer and saved the plan sponsor millions of dollars in the long run. And I understand that's one element of what Trustee Jurdy is talking about, but I want it to be known and stated on the record that we are conscious of the the very big commitment from the plan sponsor to pay down the UAAL, and have had made recommendations to the Board of Supervisors, the plan sponsors for the county, to pay that off quickly or quicker and save multiple millions of dollars in interest. So that is something that this board has done deliberately without abandoning certain investment strategies and beliefs that we have on paper. And I would personally like to hear staff comments regarding the 4 recommendations made by Trustee Jurdy, so then I can provide my comments, because I want to hear your comments first.
Mr. Rentschler.
Thank you, Chair Cavness and members of the board. I would like to point out that the illustrations used in the memo with portfolio recommendations are based on an illustration that uses essentially 85% equities to 15% bonds. The real estate index, the publicly traded Vanguard REIT, is highly correlated to the stock market, unlike our private real estate holding. And the healthcare fund, again, fairly highly correlated to the equity market. So it does actually not reduce the risk to the level believed or in my opinion presented in this memo, because of course if you look back and you're using equity-based real estate and having an 85% equity to a 15% bond, or even if you kept the bonds higher but have that higher allocation to equities by using a real estate index fund that is publicly traded, by virtue of having a higher equity allocation, a significantly higher equity allocation that comes with substantially more risk, you would absolutely expect over time for that portfolio being illustrated to outperform what we have. And the reason it does is because it has such a large tilt towards equities by use of the REIT fund as an illustration for our real estate holding, because it does not compare. You cannot use a publicly traded REIT as a proxy for private real estate because they do not behave the same, and the illustration then becomes based on a portfolio that is far more equity oriented than our, so you're not comparing the same things, you're comparing apples and oranges. So I just wanted to make that point. We have some concerns over a loss of diversification with the proposal, and the other issue that I see is the comparison of the CAGR to our portfolio return, which is a time-weighted return, because those two are not equivalent. And the I actually will probably let Robert go into a description, but I do have some illustrations of what the difference between a CAGR and a time-weighted return and the impact on the results. So you can't use those CAGRs and compare it to what our time-weighted return is based on when we have inflows and outflows of funds, which are occurring all the time. And try to draw a conclusion that a portfolio would have performed better just due to the fact that those measurements are not the same. A CAGR doesn't consider inflows and outflows in the calculation of that return. So we did provide a memo. We do have an upcoming agenda item to discuss the international equity allocation, and we can go into a discussion on whether or not it makes sense to index in that arena. There are some items that we could bring back with that international equity structure discussion to have Callan bring us information on the use of index funds if that's the board's desire. We would not recommend consolidating the fixed income providers or use of the healthcare proxy fund. The healthcare proxy fund is still relatively highly correlated to the US stock market, and it has much greater volatility. You can't look at standard deviation alone. You could say, all right, the broad US market has a standard deviation of 17 and the healthcare fund has a standard deviation of 14. So by using those two together, I've lowered the effective standard deviation of the portfolio, and you could have another portfolio, the U.S. broad market standard deviation of 17, and maybe something with a higher volatility, a 20% volatility based on the standard deviation, that might actually be less volatile because the asset class does not react the same to the stock market. The healthcare proxy is 80% correlated to the U.S. large cap market. So if the U.S. large cap market dropped by 100, you would expect to see an $80 drop in your healthcare fund. Whereas if you have non-correlated or significantly less correlated assets, even if the standard deviation is the same or greater, it provides less volatility because that $100 drop on your equities may only correspond to a $20 change or less, depending on the correlation of that asset class to the large U.S. market. So standard deviation alone is not adequate to gauge the risk. You can't focus on one risk aspect because there's so many things that impact it, and correlation is certainly a large part of that. So we did provide our comments in the memo to you. It also provided an illustration of the annual returns from 1985 through 2023 to show the best performing and worst performing segments of each market on the table at the end of that memo from staff. If you have any questions regarding the memo, I would be happy to answer any of them. Otherwise, I'll turn it over to Mr. Reveles for his comments.
So the thing that I would add here that we didn't speak about in the memo is crucially comparing our time-weighted returns to portfolio visualizers, compound annual growth rate, overstates the balance that would expect to be there. So when Trustee Jurdy makes the comparison on page 1, on page 1, that the CAGR of the Vanguard U.S. total stock market is 11.44%, and he compares that to our domestic equity time-weighted return of 11.0%. That really is a comparison of two separate calculations. They're not the same number. Like Doris said, it's really apples and broccoli is what you're comparing. And the reason why that is the case, in some instances, the CAGR and your time-weighted return would be the same number. If you didn't rebalance, if you didn't move money around, if you just let two investments ride for however long, those numbers would be the same. But the reality is that we're rebalancing multiple times a year, and we're pulling money. We're raising cash multiple times a year, every year. And so fundamentally, all of these comparisons between those two numbers are flawed. And we didn't mention that in the memo, but I want the board to be aware that these illustrations are very high compared to what would actually be happening within the fund. The other thing that I think is important for the board is the diversification considerations. And again, Doris mentioned it, but it can't be understated that the reason why diversification broadly works is because of negative covariances and negative correlation. And all of these illustrations, the substitutes for any of our fixed income or private real estate or infrastructure investments, they don't actually match any of the realized metrics that we use in the portfolio. There's a big difference between a correlation of 80 and 35. And for instance, our real estate composite is actually nearly zero correlation with the S&P 500. And that's even before the rate hikes that started in the late quarter 2020.
Trustee Comer?
That's really the only the things I would add is that these are not good comparisons for multiple reasons. Including the short-sightedness of them and the, I don't know how else to say it, but lack of other considerations besides risk and return, standard deviation and return.
Thank you, Madam Chair. If I can, I just want to water down some of the responses from our financial investment officer and executive director to the 4 recommendations made by Trustee Jurdy. And if I'm inaccurate and misrepresenting those, please jump in. So the first one was regarding asset allocations, and the staff response was basically that they're asking, Trustee Jurdy is recommending to index the entire equity allocation. That could eliminate sector and factor diversification. The second is to consolidate fixed income managers, and the response was that that exists as complementary exposure and potentially could reduce diversification. The third one was a healthcare index versus private real estate, which the response was could reduce diversification, and we're already exposed to healthcare in other funds. And the fourth recommendation from Trustee Jurdy was basically recommending a different asset allocation mix, which we just decided on last year, recanted, revoted, and decided on again, and never once was mix 5 in that discussion that I remember. It was between 2 other options, and we have a process, and I don't think that comes up again until 2025. So we'd be avoiding and circumventing the process that exists for that asset allocation decision. So at the end of the day, I brought up our investment policy statement for MSERA, and I'm just going to go over it quickly. Focus on the long run. Diversification adds value. Understand and manage risk. Simple is often better. Public investment markets are largely efficient. Investment costs matter, and strong governance is vital. So I do have numerous concerns with the comments of our staff that many of the recommendations could potentially reduce diversification, which is one point. And I also understand that some of Trustee Jurdy's recommendations could fall under other aspects of this investment strategy in this statement. I personally, we have Mr. Burke here as a legal representative, and if we don't ask him legal questions, then we're avoiding why he's here. I will kick it to Mr. DeForest in the same response. I don't know if he's had a chance to review these recommendations, but I feel like we're avoiding and not asking the opinion of the group that we pay a good fee to give us investment recommendations. So I would like to hear their response.
Alan has certainly read both of the documents and is in alignment with staff recommendations. I think the only other thing that I would add on the indexing question is, maybe we do look at indexing internet. That would be reasonable given what we've seen over the last decade. But as far as indexing the entire U.S. domestic equity allocation, no. We've already looked at the performance of those managers and the value to MSERA, and the value is there, and it's measurable.
That goes to my overall comments that at the end of the day, the investments that MSERA makes are supposed to be complementary to each other. So when one asset is not performing well, the hope and ambition and expectation is that other classes will level that out. And if we eliminate some of that diversification and we see some of the crises that have occurred in the last decade to 15 years that were unexpected when they happened, and we keep telling ourselves that 2008, 2009, 2010 can never happen again, then COVID happens, which is totally unexpected. We cannot predict the future, but we can deliberately put investments in place that complement each other in those different asset classes, which we as a group have voted on. So some of the recommendations, while I'm not ignoring anything that Trustee Jurdy has recommended, my concern is, are we avoiding the strategies and investment policy and statement that we've made, and are we circumventing the process for evaluating these asset classes when we just did it? And is there an emergency that exists now that says we should reevaluate it a year in from when we just did it?
I think council would appreciate it if I did mention that, we do have policies and we have a well-defined process. And the reason that process exists is to help the board fulfill their fiduciary duty. And it is certainly applicable to ask the questions about, should we index? Should we have an active manager bet in this arena? You know, what is the appropriate asset allocation mix? And those are questions that the board could choose to reopen. The asset allocation process is an involved process. It's typically done every 3 years. And absent a significant change, we would not necessarily recommend going back and altering the asset allocation at this time. As you did mention, it has been discussed. It was a split vote that originally in February of last year moved to a more conservative mix 3. That item was brought back to reopen that discussion, and then in April it was moved back to mix 4, which is where MSARA had been prior to the move to mix 3. All of the asset allocation options listed in the asset liability study are reasonably expected to provide MSARA with the level of return illustrated in that based on the capital market assumptions on a go-forward looking basis. We wouldn't necessarily recommend changing the asset allocation at this time. We would follow our process. We have the process there for a reason based on information. And again, the selection, and I realize that a lot of folks on this board weren't here in February or even April of last year, it resulted in a consensus of the board. The board selected that, and if we're going to reopen the asset allocation discussion every time somebody wants to change, we do a disservice because we can't get through other aspects of our review of our investment portfolio because we're having to go back and rehab the conversation about what the appropriate asset allocation is. It is my understanding that when Mix 4 was adopted, it was the consensus of the board, and that really should hold until we review that on our regular schedule unless there were some exigent circumstances. Regarding the use of index, I agree that with the international allocation, we are going to do the equity structure for that segment next, and it would make sense for us to bring back some options there for you to compare active management and indexing within that arena. And if you have any other questions, I'm happy to answer anything specific to any particular recommendation.
So I would just add in that I think if you look at Trustee Comer just quoted from our own policies, simple is often better. And we have 6 different actively managed international mutual funds. If what this board did this year was to take a serious look at indexing versus when we reevaluate the international and do a comparison, I think we're likely to go with the index because our active has not proven to be a big win. And so if we did that this year, we would have made our portfolio much simpler by going from 6 active, removing 6 active with an index. And I know there's more than one index out there, there's multiple companies. I think that would be a big win for the portfolio. Again, this board is being asked to do an awful lot of things on a lot of different fronts. Portfolio is just one of them. And I would feel very good if we could do that because then it narrows the focus of the board on the remaining funds.
If I can jump in, that is also along with our schedule because that's coming up. So I think it's completely appropriate for this board to consider it at that time and take all input that's available to make an informed decision. We have historically been, my entire time on the board, and I think Trustee Jordy would agree, a very deliberate, intentional investment strategy is what we've possessed. And we don't make rash decisions and we don't make knee-jerk reactions. So if that's along with the schedule, then I hope everybody, and I do expect everybody on this board, would be open to hear that recommendation.
We can certainly include that. The international equity structure is the next item that would be brought forth in the review of the overall portfolio. I would like to say that the investment policy statement does say to keep things simple, and while it may seem that we have a relatively complex investment philosophy or as far as the structure of our funds, et cetera, if you compare us to all of the other retirement systems, even some of the smallest systems in this state, we have a much simpler asset allocation and a fewer number of managers. I worked with Fresno where they had probably 44 managers, and they were involved in private equity, private credit. You know, if you look at a number of the funds, even the smaller ones, they're using private equity, private credit, and hedge funds, and have a large number of managers that is extremely burdensome on staff to track all of that. So in that regard, this board has done a very good job of keeping our investment profile simple. We are not using separate accounts. We're not using, hedge funds, private equity, some of the more esoteric things. There's a lot of different investment ownership structures that we haven't even touched on, but we're using essentially commingled mutual funds for the majority of our assets. Many of those funds are public, although we do use some that are not retail mutual funds, and you won't see them in Morningstar because Morningstar focuses on retail funds available to individuals, and some of the funds that we're invested in are not retail funds, but they are mutual funds. But it doesn't necessarily make it bad. That's not necessarily a level of complexity. But this board has, over time, has done a very good job of keeping that investment structure simple and avoiding the siren lure to move into more complex investments that require additional time, have higher fees, and things of that nature. So I did want to acknowledge the board's work in that process.
Further discussion?
Nobody mentioned anything about recommendation number 5, and I think there's probably a general consensus that we would like recommendation number 5 to happen. I don't know, obviously I can't speak for other people, but it seems like we've talked in the past about having joint meetings, or at least the two-way conversation that was mentioned there. And the other thing I wanted to bring up was maybe they could, if Robert could comment a little bit on recommendation number 2 with the PIMCO fund, which it seems to have been underperforming. And I was wondering, is that a fund in general that would perform well if the economy was to go bad on us?
Yeah.
Yeah.
Well, that would be the expectation. So if you look at our response memo and you look at the chart on page 3, that chart, if you look a little closer, now I only called out 2 periods where there was very large divergences from the S&P 500. But there's sort of 2 things to notice here in general, I would say. One is that for the large amount of the period, both of the lines are below 0. Now that's the sort of diversification that we would like to see. When one thing's going up, one thing's going down, maybe it's not going down quite as much, that's the diversification factor. The second thing that I would point out here when you look closer at smaller time periods is you can see that both of the lines diverge in smaller portions. So in the middle part of 2008, you can see that the PIMCO fund correlation went a little bit closer to 0. If you continue on and you look from 2017 to 2020, you can sort of see that the PIMCO, the blue line there, is lower for that period than the Dodge and Cox line. And so all of those little sort of divergences are benefits to the diversification between both managers. Now, in the recent period, both of those lines have gone above 0, and that has been a general concern of lots of folks. And unfortunately, there's not a whole lot that we can do about that with these 2 funds. When we do get to the fixed income structure review, I've got multiple ideas, and I've sort of mentioned a few to Callan and to the executive director about further diversification that we could potentially add to the fixed income. Again, you're talking about living in the same neighborhood, not necessarily a different town when it comes to this sort of thing. So, long way of saying yes in some conditions, not so much in others. If we want to have more diversification, we would have to make a change. This is what we've gotten for the last 20 years.
I would like to, I think, summarize the direction to staff. There were a couple of questions about the use of index funds. It is my understanding of the board that you would like to look at the use of index fund in the international arena, and we will bring that back as part of the international equity structure update that's going to be in the next month or two. I forget when it's scheduled. Additionally, the other direction that I heard was to reach out to the CEO and the Board of Supervisors to look at scheduling a joint meeting. I just wanted to make sure that I had not overlooked anything else, or that there wasn't anything else that needed to be included.
So it's not specifically mentioned in my memo, but one concern I have, and I've talked with Doris about this, is we don't have an apparent watch list. At different times in the past, I've heard MSERA staff talk about it's kind of on our watch list, but what she said when she came here, there wasn't a formalized process for staff to say this, and this triggers a fund going on the watch list. So, and that other retirement plans that she's worked for have had a more systematic means by which they put a fund on a watch list. And I don't have a proposal here, but I do think it's something worth discussing as maybe a future agenda item. What would MSERA staff and what does this board feel comfortable with might be kind of matrices that would trigger a fund to go onto a staff and board watch list. Again, I don't have a specific proposal for that, but I think that's something that would be helpful, because I do think that what I pointed out, that there are some funds that are underperforming our benchmark pretty consistently, but we don't have a formalized watch list. I'm sure staff are looking at those funds, but it's not coming before the board. And again, the report that we have from Callan, it's primarily focused on the managers of the funds are causing them to say it's on a watch list. It's not a formalized process that we have or something that we can track in a systematic way as board members.
I would be happy to bring back an educational item to discuss the use of a watch list, what criteria would be of interest to use as something that would trigger someone to show up on a watch list, the time frame in which something has to be, out of tilt, so to speak, and come back. There's two schools of thought on it. One camp is that they like to have a select set of criteria to say, oh, someone has underperformed 3 quarters out of the last 5. We want to start taking a little closer look at those folks. And then there's the subsequent that's saying, well, if that particular market segment or style is not in an economic environment that favors it, is it really worth putting them on a watch list? So I can kind of bring back that for discussion so we can decide as a group what it might make sense for us to look at and what type of reporting the board may like. We do have a very sort of simple item in one of the Callan presentations that shows like red, yellow, and green boxes for things like, have there been management changes, how is performance, and things like that that go into those stop light color ratings. But we can look at making something more defined if that's the will of the board. I'm happy to bring that back at a future meeting if that's the will of the board.
Yeah, so let me jump in here. Callan does have a watch list. Staff do have an informal watch list. Doris and I have worked that up internally.
Well, again, I think it'd be helpful if there was a more formalized process and that the board was aware of and could also follow along. So I would appreciate if that could be a future agenda item.
Okay, I'll add that as an agenda item and bring it back, might be a couple of months.
Further discussion on A? So we're going to move on to Allen fee from investment.
Well, can I jump in one more time? My apologies. Can we get, I mean, do we need the board to actually say, I don't think you got through, Doris, all the recommendations here.
I just summarized the two that I heard coming as board direction. If that's incorrect and there's something that I omitted, the board should let us know. But otherwise, we would just move forward with bringing back the international equity structure with a review of using index funds in lieu of active management. And now I forgot the other one. Oh, yes, the joint meeting with the Board of Supervisors. My apologies. I'm going to write that down this time, so I won't forget it again. But if there was anything else specific, the board should let me know. If you want me to go through each of the 5, that's fine, but that's what I heard from conversation.
I think the third item, there wasn't vocal support for the other items, but I'm not hearing any opposition to the idea of Doris bringing back a future item for a more formalized watch list process.
Okay, so add the watch list. That's not necessarily related to the memo, but I'll certainly bring that back. And then related to today's memo, we'll look at the international equity structure using indexes, and we'll reach out to the executive office and the Board of Supervisors regarding establishing a joint meeting. So yes, the next item on the agenda is several Callan presentations. So Greg's going to, and Hannah and Claire are going to be available remotely, but Greg's here in person. We have a memo from us regarding the fees that Callan receives from investment managers for the work that they do. They have databases of available and the type of consulting they do for fund managers. Callan's also going to review their due diligence report, and then we also have the quarterly and monthly investment reports for you today. So I think I'll just go ahead and turn it over to Callan, or did you want me to handle the Callan fee memo? Actually, let me take that first, is from me. At Trustee Jurdy's request, we did reach out to Callan's compliance office to obtain the amount that Callan received in fees from the managers. Now, each report that we received from Callan in the back has an exhibit that lists all of the investment manager firms that pay Callan for advice. That's in all of your reports every quarter or even every month, perhaps. So of MSERA's 17 funds, 9 investment managers obtained educational or analytic services from Callan during 2023. Those included Alliance Bernstein, Barings, Fidelity, Janus, JP Morgan, Mondrian, PIMCO, T. Rowe Price, and Vanguard. MSERA has hired 5 firms before Callan came on, 5 of those 9, and the individual fees varied greatly, but in 2023, those 9 managers paid a total of a little over $600,000. Those lists are updated quarterly, and you'll see someone drop off and new people add on. It's been fairly consistent for like T. Rowe Price and Mondrian that have been long-time clients of Callan's consulting there. So if you have any questions regarding that memo, I'm happy to answer them. I would like to mention that, when we did the consolidation of our domestic U.S. equity a few years ago, shortly after I came on, we eliminated some active management in that realm, and the active managers that we eliminated were actually clients of Callan on the investment manager consulting side. So I think that shows that the advice that we're receiving from our local team here, as far as what's appropriate for MSERA, is truly independent and unbiased advice.
oh,
Yes, we're
Very
going to turn it over to Callan. I think we're going to start with due diligence first, or if you want, we can move to the investment report. We have them on the agenda as due diligence, but we can take them out of order if you want.
Yeah, so maybe we start with the summary presentation, if that's okay. I think Claire might share her screen. Claire looks forward to driving up here soon. As you
Okay.
know, she's working from home right now until she gets the rest of her personal life all organized and all that. So
Just for the benefit of anybody watching, we're going to take this out of order. We're going to take item 3E, which is the quarterly investment summary report, correct?
yeah.
Thank you, Chair. I apologize for that.
fine.
And Doris mentioned Callan's business model. I don't want to put her in a position where she has to describe what we do. So if anyone has questions about it, one thing, Callan's very proactive in disclosing our business model, and it's in our APs, it's in the reports we send to you. We're very open and transparent about it. It was part of the due diligence process when you first hired us later. So if you have questions, I'd be delighted to answer anything. We're very open and transparent about it.
So I have a question, Greg. So we added real estate, well, we hired Callan, and I don't know, can you maybe refresh us on the sequence of events? So we hired Callan as the advisor. From what I gather from previous board members, it was an upgrade from who was previously advising MSERA.
Yeah.
And then at different times, different asset classes have been added in. So can you refresh our memory? Was real estate added after Callan was hired, or was real estate already a part of MSERA's portfolio?
I'd have to go back and refresh my memory on that. You may have had some private real estate at the time, but I would have to.
It was
I would-
already there. Yeah,
15 years ago?
yeah.
So were the same two funds in there at that time?
We signed up with the Reef Fund in 2004, and we signed up with the Barings Fund in 2012.
Okay, and Callan
That
came,
fund wasn't called Barings at that time, though, is that correct?
No, it was
Cornerstone
called,
Patriot?
Cornerstone.
Cornerstone Patriot Fund.
Yeah.
okay, and that was 2012.
Yeah.
When did Callan come on board?
We were 08,
2009.
09.
Okay, so
Yeah.
Barings came on board, or no, Reef came on board, you said?
I didn't say that.
04. Reef came on 04 before Callan.
Okay.
Callan came on 09. Barings came on 2012.
Okay.
Yeah.
And I realize in the staff report, it says that these companies that are currently on your list have changed over time. A company could be paying for 1 quarter, or they may drop off maybe they pay for a year, but they're either landing on your page that you publish, and sometimes they drop away over time. So,
Yeah, if they're not a client of ours, we don't put them on the list.
so
Right.
with the caveat that Barings
Yeah.
may not have been a client of Callan's in 2009 or 8 when it was added, or 2012 when it was added to the MSERA. That may or may not have been the case, but they are
I don't know.
today.
Yeah.
And, but I do still want to remind the board that when we look at the performance of those two real estate funds, the Reef Fund, the one apparently the MSERA has held the longest, in the last trailing 10 years, earned 6.83%. In the same 10-year period, the Barings Fund only earned 4.31. So it was 2.5%. I mean, it's like a 30% reduction below the other fund or more. So to me, that would red alert, put it on the watch list.
And
You
they
know,
are on our watch list.
And to a lesser extent, within our bond equity, as I pointed out, now Robert's made the case that there's a divergence in how they perform, but it is also true that in the last 10 years, the PIMCO fund has dramatically underperformed. Ironically, and maybe not unusually, we, like many funds, added PIMCO after they had a really good run. So PIMCO had a really good run, and this is, I think, not uncommon, is a fund has a really good investment strategy. It really pays off in the economy that exists at that time, and then a lot of capital flows into that fund. Either two things can happen. One is that particular play plays out, and you can't make as much money, or two, there's just too much capital to reinvest, and they can't do it at scale. So I would point out that both PIMCO is currently listed as a client of
Yep.
Callan, as is Barings, and
Yep.
they're the two, within those two asset classes, they are the two worst performing within each of those asset classes. And in both cases,
I'd be
it's,
delighted to talk about performance when we.
okay, well,
So are there any other questions, though? You know, the one thing I wanted to flip to first was slide 32. If you don't mind, Claire, thank you so much. I just wanted to remind people of the calendar and the cadence of the work that we do for you. We have been we've been kind of stuck talking about asset allocation for about a year and a half. And that's the biggest, most important decision you make. 80–90% of the return pattern comes from that. The success of your investment program, heavily reliant on asset allocation. Claire, I'm trying to be on the calendar, thank you. So we've been talking about that for a while, and we keep going back, and we're not moving forward. Where are the things that we want to move forward? It's actually a lot of the things that people are talking about, but they're just not sequencing them in a fiduciary process, documented fiduciary process. So what we want to next start talking about is, well, what do we do in each asset class after we determine what asset classes do we have? So we already talked about domestic equity. Remember the last couple meetings we talked about domestic equity. We decided to be passive large cap, active small cap. And then we said, do we like our small cap managers? And we all collectively agreed, yeah, we like them, we're going to keep them. After we pass through domestic equity, what do we got next on the list here? We've got international equity. So that's the next step in the process. And I agree, there's some wood to chop here, right? There's some things to look at and some things to do, but we need to get to it. So let's look at active and passive and international. Do we want small cap? Do we want dedicated EM? Let's get to it and let's talk about it. But we haven't been able. So that's the next thing we're going to be talking about is international equity. After international equity, who we got next? Fixed income. And then we'll talk about, well, do we want one or two bond managers? If we got two, are we more diversified than if we got one? Yeah, probably so. And not one is always going to be the best. Kind of by definitions, one's the best and one's the worst. But they both beat the index. They're both better than passive, net of fees. After we talk about fixed income, we'll talk about real estate. Yeah, Barings has been doing terrible. Maybe we should have someone else. But we got to get to it. We got to move on and start talking about that asset class. So this is the multi-period calendar that we're trying to work towards. Okay, let's go back and let's pull up our watch list. We'll kind of cut to the chase here a little bit. So when we come and we meet with you quarterly, we do have a holistic assessment of how each of the managers or the funds are doing. And we want this to be simple. We want people to be able to look at it and say, hey, what's the key takeaway here? And we've been publishing this for a while. This is in your reports. And here's where we have Callan's assessment using Callan's proprietary analytics, Callan's investment manager team. We'll talk a little bit about them. And we come up with the overall assessment of the managers. And so we give this to you, and this is our watch list. Now, if you look at your investment policy statement, it's not codified in your IPS that you have a watch list and it's this criteria. Doesn't mean you don't do it, but here it is, and this is what we've been sharing. So notably, Barings is yellow overall. We've got Prudential and low price stock yellow overall. And we also highlight the firms that aren't performing well, but We think it's still within expectations, so we've got a couple international equity managers that we note there as well. So how do we come about and come up with this overall assessment? Maybe we'll spend a few minutes talking about Callan's due diligence process. And with that clear, maybe we'll flip over to the other presentation. And Doris, you might want to tell the public what number it is. Or
Thank you. So for anyone watching, we're going to be moving to item 3C, which is Callan's due diligence presentation. Thanks.
thank you. Okay, so how does Callan actually come about and come up with our manager due diligence process? And I thought it was great that Robert got to come down and spend a few days with us in San Francisco and got to meet our due diligence team. So we have if we flip ahead, Claire, we have a dedicated group of specialty consultants at Callan. Callan has about 200 employees. Claire, Hannah, and I are part of our consulting team. There are about 50 of us. And in addition to us, we've got 57 specialty consultants. So these are people who focus on doing manager due diligence, focusing on doing asset allocation work, and that sort of thing. Now, these are really important people at the company. 3/4 of them are shareholders of the firm, 26 advanced degrees, 29 CFA and Kaya. And they're a real key thing of what Callan does, is our research. And we do a lot of research. We do a lot of searches, if you will. Here's some statistics. We placed about $260 billion over the past, I think that's 5 years, and about 1,200 searches. We generally do a couple hundred searches a year where we go on and we look for a manager for one of our clients. So overall, Callan has about $4.6 trillion in client assets, and we have about 560 investment pools that we work with. So that gives you the sense of the scale and the scope of what we see. You know, we spend a lot of time and money doing this manager due diligence. And we invest in our own products, our own research tools. So Morningstar is a great provider. We buy their data and we put it in our system. But it's not the only thing we buy and we use. We also create our own stuff. We have our own research people. We come up with our opinions. We don't just rely on Morningstar data or opinions. That's why we have these people, right? So we've got our proprietary data analytics and database too. Real important, real key to us. We think that's a competitive advantage, right? We can have an opinion that's different than what's published to the entire world, right? That's a competitive advantage. So let's move ahead, Claire. So here's some of the faces of the people in our research team, and you might recognize some of them. So we had Mark Wood talk to you about small cap managers and ESG, right? When Robert came and visited, he met with Mark Stahl as well. He oversees the entire public market research platform we have. And Nicole he met with as well. Over the years, you've met with Lauren and our international equity team. And when we do the international equity structure, this team is going to be really important in how we evaluate your managers. On the next slide, we have additional faces, people you've met with in the past, fixed income people, multi-asset class people. And then the next two slides, we have our private market research group. So here's our real asset team. You've met with Avery and Aaron and Munir over the years. And then the private equities on the next team, you actually don't have these assets. So we've got this big team, and we've never recommended that you actually use them, right? Because we don't think it's a good fit for you. And you've agreed to that. times, but we still have all these people there who help us come up with opinions in hedge funds and private equity and all that sort of. So to me, that, okay, let's move on from that. What else we got here, Claire? So how often do we meet with your managers? So here we have the list of the managers, the last time we met with them, and the number of meetings we've had with them. So this just kind of shows the scale and the scope of our research platform and how frequently we are in touch with the investment managers, investment funds in your plan. And then here's another, this is the monitoring report, stoplight page. So the result of all that work is that we have this stoplight page that we use to communicate to you who we have on watch, who we think's doing good and who's not doing good.
So question, on the Barings, which is underperforming the REEF fund by 37% over the last 10 years. So it's not a 1-year blip, it's not a 2-year blip, it's over a 10-year period. It averaged 37% smaller returns than the REEF fund. Why would it only be underperformance and overall? Why would it only be listed as notable change, not significant concern?
I think I could probably answer that. So before, sorry, Greg, let me jump in. Before the rate hikes, right? Rate hikes starting in 23, 22 have really put downward pressure on transactions, prices, everything related to real estate. Before those rate hikes started, Barings' 10-year return was over 9%.
So we're comparing it to our other real estate funds.
No,
it's 37.
Barings return was over 9%. Our composite return, both of the managers on a 10-year basis before the rate hike started, 10%.
So they're both real estate funds. And in
Yeah.
the same 10-year period, Barings is showing a 30% smaller rate of return than REEF.
Right now, Barings is on maybe a 27% drawdown versus the index at 20% versus REEF at 20%. The reason I'm bringing that up is because the reason there's been underperformance has been primarily the last 21 months.
So I'm talking about,
Before that, these folks wouldn't have been anywhere near this.
these are performance of one relative to the other. They're both real estate funds. I'm not talking about total return. I'm talking about relative to each other. In the same 10-year period, Barings, 37% smaller return than REEF.
Barings has had 2 quarters of large drawdowns. Now, we're still going to see what's borne out in the index. I think the consensus is that the Odyssey index, right, has an average cap rate of 4.7%. What's the 10-year at? 4.5%.
I do want to clarify, we don't necessarily compare one real estate manager to our other real estate manager. We are comparing them to the benchmark. And you're correct that Barings has had significant underperformance to the benchmark, especially since, as Robert mentioned, the last 21 months when the interest rates went up. I would also like to mention that Barings has been much more aggressive in marking down their properties faster than the benchmark and REEF. So those are 2 comments I just wanted to make. I'm sorry, you had a comment, Trustee Land?
Or a question. What do you have to do to get the red light and to find yourself with significant concerns?
Yeah, so we would come up with it's a holistic assessment for ours. We don't believe in rule-based triggers. I think rule-based triggers force you to do something sometimes you don't want. So we come up with, in other words, you underperform by X% over a 3-year time period. Well, if there's an explanation as to why that happened, don't make it a rule-based trigger, right? So it's an overall assessment. If we start Barings, if we start seeing a lot of money flow out that door, that's probably when it would tick to red. If we don't see their performance improving, that's when it would tick to red for us. One of the practical limitations right now about private real estate, though, is you could tell them, give me all my money back. They'll say, I'm sorry, but we can't give it. That's the way private investments work. So the private real estate fund, even if we marked it red, say we want to redeem all of our money today, we'll say you're going to get in a queue, and we'll get you the money when we sell a commercial property, right? So a little bit of this is stylistic, right? Is it yellow? Is it red? We could debate that, right? That's fine, right? But it doesn't really affect the investment action you can take.
So there's a relative aspect to that. If the entire industry is doing poorly and our investments are doing poorly also, that wouldn't necessarily trigger any concern.
Yeah, I understand that portion. That's kind of, but I guess the bigger question would be, when would we know that something is in danger of going red? Would we ever know that? I mean, would we have any kind of, or would we just suddenly get a report and we got a bunch of red on our graph?
Well, it's my job to come and tell you when issues are coming up, and we'll notify you. This is one communication tool we have with you. Hey, things are looking suspect in a few of these areas. So this is one of our communication tools that we have to let you know what we're thinking. And then of course, anytime we do the manager structure work, kind of the next few steps of our process, we'll also do a deep dive on all of the managers at that time as well. No, maybe we go to the performance summary presentation. We'll start talking about performance. Oh, yeah, we have more information on our database, and I won't.
So are we going to go to the full quarterly or the monthly, so we know what we're on?
So it's our summary presentation.
You want to go back to item 3E, the quarterly summary?
Yeah, thank you. Thank you, Doris.
You have to leave me a trail of breadcrumbs or I'll never find you.
Well, I'm not linear today. I apologize. Okay, and now we're going to transition and start giving you an update on overall performance for the investment program through the end of the quarter. We also have performance through the end of April in a flash report. And anytime we start talking to you about quarterly performance, on the next slide, we always anchor you on what happened during this time period. So that way you have some information to be able to evaluate performance, to put it into context, right? So here we have performance for the broad capital markets through the end of the first quarter. And here you'll see that it was another really strong quarter for U.S. large cap stocks, up about 10%. 1-year return up about 30%. And really strong returns. Now we have another column in here. And when our research group started publishing it, I was like, what is this? Since January 2022. What's that time period? Well, that's since the interest rates started going through the roof, right? The interest rate increases, right? And over that time period, if you do the cumulative return through there, stock market's up about 5%. So that includes the really bad 2022 and the really good 2023, and quarter to date, or year to date 2024. So over that time period, stocks are up about 5%, which is good. Not quite as much as a lot of people think, though, right? Over both the down market and the up market. Over this time period as well, international stocks have performed well, right? They've actually done okay. The only thing is people have a little bit of FOMO because US large cap did even better. That doesn't mean international's bad. Just means something else did better, right? So that's why we still think having both of these asset categories is really important. Because right here, this is like the demonstration of diversification. One's up, the other's not up as much. So that relationship will flip someday. And that's why we think you should continue to have both asset categories.
So Greg, it wasn't in my memo, but Nevada, the state of Nevada pension fund, which is a client of Callan,
Yeah.
of their public equities, they have 70% US, 30% international. We are also a client of Callan, and we have 60% US, 40% international. Is the state of Nevada wrong and we're right?
I think you're both right.
So would we be making a horrible mistake if we had 70-30 as our allocation?
You already made your asset allocation decision. You changed it twice. My recommendation to you, if you're managing $700 million, you don't keep changing things. You make the decision, stick to it.
So is your recommendation that we have 60-40? In all scenarios with the asset allocation, it was always 60-40. Regardless of how much equities, it was always 60-40. Are you saying it would be a mistake if this board had a 70-30 allocation like the state of Nevada?
I'm saying that you made your asset allocation decision as a result of your asset allocation study a year ago, and I wouldn't look at your asset allocation again and again and again and again.
Okay, so are you going to recommend not considering a 70-30 the next time it comes up for review?
Well, in 2 to 3 years, we'll take a look. We'll see what the market looks like then. We'll see your position, and we'll make that decision. And what year are we doing asset allocation?
2026.
2026 is right around the corner, it seems.
Yeah.
Again, Nevada's situation might be different. Their asset liability, the amount of risk that their board has expressed interest in taking is different. It is not a one-size-fits-all. And you'll find that there's different amounts of a split between domestic and international with all of the different plans. And just like you have different allocations to fixed income or to private assets or private credit, you know, it is based on our asset liability study, based on a projection of our liabilities, based on our policies and what this board has defined as what all factors into the recommended portfolio. So there isn't one right answer because it isn't a one-size-fits-all.
Okay. So maybe we'll flip ahead to the next slide and give a little update on the economy. The economy continues to chug along. Over the long run, capital market returns should be linked to underlying factors in the economy. Growth, inflation. Economic growth remains stable and positive in the United States, but inflation remains stubbornly high. We actually had an inflation print out this morning, I think it was 3.4 or 3.5. It actually moderated slightly. So that's a pretty good sign. But inflation is taking its own sweet time to moderate. And we still probably have a little ways to go in the inflation fight. That means the Federal Reserve isn't going to be cutting rates until the economy starts meaningfully softening and inflation starts to come down. And on the next slide, we have a number of charts that show how expectations for federal funds cutting has changed over time. 6 months ago, everyone was predicting a recession, and not so much right now. If you have a recession, people are expecting 5 or 6 rate cuts, and now the market is pricing in 2 this year. So huge change. One of the big takeaways for me on that is be humble in your projections, right? Consensus was very different not too long ago. let's flip ahead to the PDF slide 10, and we'll start talking about the plan. And there we go. And I'll provide a few high-level comments before handing it over to Claire to talk about individual managers. But this tracks assets over time. So, okay, so this is about when I started coming up here about 15 years ago, or at 6 in the morning. And we had, you had about $250 million then, and you're now sitting about $700 million. So we ended the quarter at $711 million. And I think you all are just staying the course, having a good strategy and sticking to it, knowing the balance between benefit payments, contributions, and investment policy, that pays off over the long run, right? So over the quarter, a pretty meaningful increase in returns, investment returns. So the investment program increased, is that $55 million? I need my reading glasses. And then a net outflow about $7 million to make benefit payments. So a good quarter. We gave up a little bit of ground in April. You'll see that. Back below 700. The next slide here, we show your target allocation versus the actual allocation. And we always want these two pie charts to look as reasonably close as possible. We're not taking bets against the policy target. We think that's a quick way to lose money and not make it. So we want to have a disciplined rebalancing towards this policy target. This is your number one risk control strategy to do, too. And you'll see that we have the private real estate, the infrastructure, fixed income, and then the majority of your assets are in equity product. And you'll see the deviations between policy target and actual allocation are pretty minor, within about 1% of each other. Now, notably with the private real estate and infrastructure, that's not something you could just rebalance to like a stock or a bond. There are time periods when you can take money and put it in, so that's a little bit of more of a dynamic process that Robert has to manage. In the next slide, we show your asset allocation over time. You'll see the introduction of infrastructure. Kind of hard to believe that's 3+ years ago now that we added an infrastructure investment. And you'll see the zigs and zags of the lines at the top, a little bit of movement. That's just from market movement and rebalancing back towards target. You also see that the international equity allocation has come down. I remember we actually did that at the last study. And the next slide here is your allocation versus a bunch of other public funds out there. You're the dot, the triangle is your target, and the floating bars are other public funds out there. So you'll see your dots a little higher in some categories. All but fixed income, you actually have a low fixed income allocation. But why is it higher in the other areas? It's because you're not in a bunch of other categories. And then the math is, well, where's the money go? It's got to go in this category you do have, right? So you're not in international fixed income alternatives, hedge funds, private equity. Never thought those were great fits here. So that means you have a higher allocation in other asset classes relative to other public funds that do have those allocations. Okay. Asset allocation so this is, we talked to you about the broad asset allocation, stocks and bonds. Now we look at the individual managers within each bucket. And, your biggest line item is the S&P 500 index fund, the Vanguard fund. So that's 26.4% of your investment program. It's in the S&P 500 index fund. And you see all the other allocations are a few percentage points, exception being fixed income. You've actually got about 10% in each bond manager. You know, I wouldn't put that much more in any one of them. It's a pretty healthy allocation for an active manager, right? Having 10% of your fund, I wouldn't go to 20. And then you've got, you know, the 3, 4, 5% positions in all your other managers. So we could be upset at any individual manager here, and we should, and we need to hold them accountable and terminate them when we're not happy. But keep in mind, it's about 3%, 4% of your portfolio. So you don't have all your eggs in one basket for the active managers. Okay. The next slide here shows performance relative to your policy target and other funds. So the last year hasn't been great. Hasn't been bad. I tell you what, 12 months ago, if you said, hey, you know, we'll have a 11.5% return, we'd say we'll take it all day long, right? We beat our actuarial rate of return pretty handedly. But it's in the 80th percentile of the peer group, and it's a little bit behind the benchmark. Big culprit here is the private real estate managers, and Barings is the #1 headwind here. Now, if we step back and say, okay, we're a long-term investor, really worry about the 7, 10, 15 years, your numbers look really quite good. And we've demonstrated that over the past few meetings, how your expected rate of return has, your actual return has exceeded your expected rate of return when you link them over the time periods that you get them. Right, so long-term performance is good. Most recent performance is, you know, we could have done a little bit better. And a little bit of that comes down to Barings. So with that, maybe we'll flip ahead to the line chart. This shows the aggregate change in the returns over time for the fund. And this is for about 15 years. So there are ups and downs. But more recently, there have been more ups and downs. And then we take a look at volatility, standard deviation on the next page. So for those of you who've been on the board for a while, recall that we were even more heavily tilted towards equity historically, and we intentionally added infrastructure to try to bring in the volatility, because the #1 determinant of volatility is how much stock exposure. That's the most volatile asset we got. And over 15 years, kind of the legacy allocation, you'll see the volatility is high. It's to the right. Over the last 3 years, we're lining more towards the average, the volatility of the average fund out there. Sticking on total fund here, let's look at attribution. So on the next slide here, we have attribution. So I can tell you what the return is. I can tell you what the volatility is. Now you might ask the question, well, why? Why is it what it was? Right, so that's attribution. Here we're showing the quarter return and then the 5-year return. And over these 2 time periods, you outperformed the benchmarks. And the manager effect is actually positive in both of these. So if you add up the contribution of all your active managers, they've been additive. That's what this chart is telling you. Okay. All right, now let's flip to the next slide, and I think Claire is going to walk through and spend some time talking about some of the individual managers in the lineup. We can't hear you, Claire. Her box is lighting up, so it means her microphone is getting her. You try again, Claire?
I sure can.
There we
Can you
go.
hear me?
We got you.
There we go.
Thank you.
Okay. All right. Apologies for that. So as Greg mentioned, in the next couple slides, we get into the returns for each individual manager and the individual asset categories. So large cap, small cap, mid cap, all within domestic equity are shown here on slide 21. And to reiterate something that Greg mentioned earlier, there are a lot of numbers on this page, but the S&P 500 index right here is the one that makes up the largest share of the total domestic equity portfolio. So that's about 25% of the total portfolio. It was about 26% as of the end of the quarter. And that's the biggest number on the page. So for the last year, the S&P 500 index was up almost 30%, and 25% of the MSARA portfolio was invested there. Now, the remainder of the numbers on the page represent the small and mid-cap managers that you have investments with. And each of those managers hold about 3% of the total portfolio, and each actually turned in quite impressive returns over that same one-year time period. When we look across the investment managers in the domestic equity portfolio, the S&P 500 index was up 10.5% for the quarter, again, about 30% for the year, double-digit returns over longer time periods, and importantly, tracking its benchmark, so that passive implementation. And then the mid-cap managers, each up about 8.5% for the quarter, and close to 20% for the year. So your small mid-cap value manager, the Fidelity Low Price Stock Fund, up 23% for the year, and Janus, the mid-cap growth manager, up about 18% for the year. Longer-term returns for both of these managers are also solid, double-digit across longer time periods, and each of them has outperformed their respective benchmarks over those longer time periods. In the shorter term, the last quarter and year, your value manager outperformed the mid-cap value index, and your growth manager did trail the mid-cap growth index. But when you put them together, which we look at later in the report, we actually see outperformance over all time periods. So that tells us that they remain good complements to each other. And I know at the previous couple quarters of meetings, you've done a deeper dive review of these managers and other managers in that asset category. Similar story within small cap. So over the recent quarter, one of your managers outperformed. That was your small cap growth manager, AB, up about 11% for the quarter versus 7.5% for the index. Your small cap value manager did underperform its benchmark, and small cap value as a total category trailed small cap growth. But when you put them together, we think they do remain good complements to each other again, and we have that report in a few pages. Over the trailing year, each up about 20%, the value manager up 24%, your growth manager up about 19%. And then over longer time periods, both managers turning in solid returns relative to their index and their index asset category. I went through all the detail of the investment managers, but at the top of the page, we have the total return for the domestic equity portfolio when you put all those pieces together. Again, large cap being the largest piece of that, and then the small and mid cap managers providing the active management there. Now we see that the domestic equity portfolio has underperformed the Russell 3000 index across all time periods shown here. The key driver of that, which we looked at in the domestic equity asset category review, is actually that you have a structural overweight to small and mid cap managers. So that's a bet that you've made in the domestic equity portfolio. We just looked at that again, reconfirmed that we do still think it's reasonable. But small cap has underperformed large cap. The S&P 500 index has been the driver, has been the place to be. It's been the biggest return of late. And so because of that small cap overweight, the domestic equity portfolio has underperformed, not necessarily because of the active managers underperforming. One page ahead here on page 22, we have performance for the other asset categories in the plan. Top half of the page being devoted to international equity, and the bottom half covering domestic fixed income, infrastructure, and real estate. International equity, as has been talked about in this meeting, is the next asset category that we want to review holistically, looking at the structure of it as well as each of the individual active managers. And it's been the most challenged asset category for this plan. That's not new news. It has been the most challenged asset category over a number of years now. When we look at the performance of each individual manager, there are a few that stand out. And then when it rolls up together, the total asset category has underperformed the MSCI ACWI ex-US index as well. For the recent quarter, your growth manager, the Euro Pacific Growth Fund, did outperform its benchmark, as did Oakmark International, as did Harbor International. That's sub-advised by Marathon. Both of those managers turning in solid performance for the quarter, and again, versus their respective benchmarks. The other two managers, Oakmark and Mondrian, did underperform. You have two specialty managers within international equity. So that's the T. Rowe Price International Small Cap. And you have a dedicated emerging markets manager as well. That's 91. In recent quarters, we've looked at those two managers, which had both struggled to outperform their respective benchmarks. We were pleased to see them outperform this quarter with trailing one-year performance recovering as well. One of the things that we'll look at in the international equity structure study is whether or not we want to maintain these dedicated allocations. What's the right amount of the portfolio to have in each of those? Because small cap in particular is actually out of benchmark. There isn't small cap in your MSCI ACWI ex-US index. That's a bet that's been made within the portfolio, and one that's contributed over longer time periods. So when we look at the 5-year return, that small cap allocation has contributed positively to the returns of the total category over time.
So Claire, I have a question.
Absolutely.
How does Callan look at risk versus return? So for example, in this chart, we're seeing return versus benchmarks. So we're seeing, if I'm reading it correctly, about 3.75% return from international portfolio versus the MSCI 4.75. So about 1% less return over a 10-year period. But during that same 10-year period, by my calculation, we had a standard deviation. This is based on your own reports. Our international portfolio had a standard deviation of about 11.5% higher than the index. So not only did we get a substantial reduction in return over 10 years, we also achieved that with higher volatility. So it seems to me that it's kind of a double whammy. I mean, not only are we getting less return, we're also getting it with more volatility in the fund. And so how does Callan look at volatility and standard deviation in addition to just looking at raw returns?
Sure. So this page focuses, as you said, just on the returns. And in our larger report, we have a lot of risk metrics as well as risk and return metrics. And we like to put all of that together to evaluate each individual manager as well as the asset category. Where are you taking your bets? So where are you, as a board, willing to take on additional volatility from a specific manager because you think you might get paid for it over the long term? Now, to your point, as of the end of the recent quarter, March 31, the international equity category hasn't outperformed. And some of the managers have outperformed and others haven't. So that's what we're going to dig into more. But we put all of that together. You know, where are the risks, or where are the bets being taken within each individual manager portfolio? Are those paying off? Do we think they were reasonable bets? What's the process to get there? And what's the return as a result of that?
Okay, thanks. Because I mean, guess what I'm looking at with the international in particular, I'm seeing we're getting a guarantee of higher volatility, and we're not consistently even equaling the average return. So even if one or two of the funds are beating their own benchmarks, what they're delivering to the fund is extra volatility, and the category of international is underperforming. So that's where I would say, from risk return standpoint, it's not working for MSERA. we'd be better off with an index and international clearly based on past performance.
And one of the things you'll want to look at in that discussion is what index, right? So does it include small cap? Does it include emerging markets? Thus far, the decision has been to include or to use an index that does include emerging markets, and therefore it's reflected in your portfolio. And then there's an out of benchmark allocation to small cap, and those two can be key drivers of volatility. And those are things that you've evaluated over time, and we want to look at again as far as the structure of the portfolio, also drilling down into the individual managers.
And so I'd like to also
Does that
point
answer your
out,
question?
I'd like to point out also to the trustees, in the larger report, each manager and composite has some risk return characteristics. So for instance, the larger report, page 50 of the PDF, or page 47 of the larger Callan report, shows a couple metrics there on a 5-year basis: Sharpe ratio, alpha, excess return ratio. So you can also look at those to see some of those risk return characteristics.
Okay, Claire, were we moving on to fixed income, the bottom line?
Okay. Sure thing. So within fixed income, as has been mentioned, you have 2 active managers, Dodge & Cox and PIMCO. And the short of it there is that both managers continue to do very well versus the index. They're both beating the index net of fees over short-term and long-term time periods, and they remain good complements to each other. So fixed income is an asset category that I think has been particularly successful in this plan, consistently outperforming that Bloomberg Barclays aggregate and working together to deliver that performance through different market environments. Any questions on fixed income? All right, the last 2 asset categories on the page here are infrastructure and real estate. Notably, real estate has been the most challenged from an absolute return perspective in the near term. So over the trailing year, down about 14–15% in total. Now that's reflective of the core open and real estate industry as a whole. That's reflective of all of the investment opportunities within real estate because of higher interest rates, because of low transaction volumes, et cetera. Now, one thing that I would note is this is something that we're watching closely, looking at real estate as a category in total, and we've seen some changes in the recent quarters. So in the last quarter in particular, you'll note a negative return for both the total real estate MSERA portfolio as well as for the benchmark. But that's a less negative return than we've seen in previous quarters. What that means is that we've seen depreciation slow. So income as a component of these real estate returns is starting to become, or is starting to more offset the depreciation that we've seen in the asset category. Again, we're continuing to watch this closely. There's low transaction volume among private real estate funds. And as that picks up, I think there will be some price discovery and we'll start to see some narrowing in terms of the returns that we've seen from that asset category as a whole in the last couple of years. Your 2 managers, Reef and Barings, both turned in negative returns in the quarter, but down about 30 basis points for Reef and 1% for Barings. So again, we're starting to see in both funds income from their investments offsetting some of the depreciation from the assets that they hold.
So,
And then income.
Yeah.
So,
yeah.
Go ahead.
Yeah, no, Claire, I was just going to say, so the remainder of the presentation, we walked through each asset class, and we'd be glad to do that, or we can move to the April report. I'd like to defer to you all how you want to spend your time. I just know that we've been in here for about 2 hours and sensing that some people might want to stand up at some point.
Robert, is there anything you'd like them to hit on?
Nothing in particular.
Maybe I'll just speak to the April report. Assets declined over the month, and we're now sitting at about $691.6 million. And the largest detractors, not surprising, is, the equity market gave up ground April. On a month-to-date basis, equity prices are rebounding currently, right? Thank goodness, right? But we've had quite a run, and we shouldn't be surprised if we give up a little bit of ground, right? But overall, the portfolio continues to, in aggregate, you're sitting really close to your policy target, and we'll continue to come back and share with you opinions about managers, and then over the next few meetings, we'll also start cycling in to talk about a deeper dive in each asset class.
Discussion? The report? Okay. Public comment. Is there any public comment?
There is no public comment.
Thank you very
Thank you
much.
all. Thank you all so much. It's great to see you. Yeah. Okay. Thank you.
Claire? So let's take a 10-minute break. Then 7:40. And our next agenda item is discussion regarding fiscal year 2023-24 budget update. Mr. Rivales.
Trustees, you have the preliminary quarterly budget update for the third quarter fiscal year 24. Happy to answer any questions you may have. As a brief commentary, we do expect to be under budget, and we're not really expecting any surprises. I guess that's the nature of a surprise, but.
That is. How did you do that?
Yeah, I guess I shouldn't say no surprises, but the probability of surprise seems to be low.
Okay. Any questions, discussion?
Is this just a receive and file?
Okay. Is there any public comment?
There's no public comment.
Thank you. Okay. Number 5 is discussion and possible action regarding proposed fiscal year 24-25 budget. Presenter is Mr. Rivales.
I'll actually turn it over briefly to Doris if she wants to introduce it.
Thank you. We did put together a proposed budget. We asked trustees if there were any items that wanted to be included. We did receive one response from Trustee Jurdy regarding a subscription to Morningstar for trustees. We provided some additional information on the amounts we have budgeted for different educational events for trustees. And if you have any questions, we're happy to entertain any questions. I'll turn it back over to Mr. Ravelas so he can go over an overview.
Were there any particular, aside the comment from Trustee Jurdy, we'll definitely get to his request, but was there any other high-level thoughts or comments, concerns about it? One thing that I guess I would point out in terms of the administrative budget and the board expense budgets, I guess would be training. The training line items include travel and an additional 3 meetings for trustees in person. I did mention this in the memo, but some of the upcoming CalPERS trainings are going to be in person, and so that's driving a large expense in those costs. I mentioned the actual registration costs going from $125 in 2019 to now $300. So on top of that $300 would be travel costs and potentially a hotel stay, depending on, if the trustees want to stay the night. So those are a little bit higher than they have been in the past, and those same sort of issues are found in the administrative training budget for staff. We also included some funds in the board expense for potentially a group meeting between the Board of Supervisors and the Board of Retirement. We wouldn't be able to use this room in that instance. We wouldn't have space for all the trustees. So our thought is that we potentially would use the conference center at City of Ukiah so that everybody could be there. And there's plenty of room for the public. If we were being cheeky, we might even ask the county to chip in half of that for that cost. But I budgeted the entire funds for us.
Is there any board member discussion? So since this is an possible action item, is there a motion? Yes.
Well,
Okay.
yeah, so I'd like to discuss, so, in the proposed budget between staff training and board member training, it's nearly $74,000. And I'm sure board members are getting value out of those trainings. And I look back at the time I've been on the board, I've only attended 2. One was Callan's in San Francisco, and another one was a third-party group in Napa. And I personally felt uncomfortable attending those conferences because there were so many salespeople at those conferences. I think I was told that there were 2 salespeople for every trustee who was from a pension fund or employee of a pension fund, and that was the ratio by the organizers. And so anyway, so I that's why I haven't been going to them, because I just didn't want to be bombarded by salespeople about, you need to invest in our fund. But anyway, but in the 2 years that I've been personally paying for Morningstar, I feel like I've received so much more substance about investments, about mutual funds, comparing one from another than I've ever received during my time on this board. And I think, for a mere $3,000, every trustee of this board and Robert and Doris and the alternate for the retirees could all have an annual subscription to Morningstar. And I honestly think there is tremendous value in that subscription. And, I recognize not everybody would probably spend as much time as I spend on looking at it, but I have a hunch about half of you guys probably would get addicted to reading Morningstar. And they have email alerts, where they'll send you as many as you want, basically, which drives you to their latest columnists, their latest opinions, and again, mutual fund reviews that are not fully available to the general public unless there's a subscription. So I think it would, over the next 5 years, it would probably change the perspective of whoever sits on this board if this board all had a subscription to Morningstar. So I think it'd be a very, very good investment. And we're already budgeting nearly $74,000 for trainings. I think 3,000 more or subtract 3,000 from that 74, either way, I don't really care. I think it's the best investment we could make is if we had that $3,000 investment in the people who serve on this board and the key staff.
Harris?
My interest in what you're saying is obviously personal. I cannot pick up and go to any of the trainings that are offered. I know that you can sign up remotely, and I've done that in the past. I don't know much of anything about Morningstar except what I've learned through you, Dan. But the $3,000 for me, until I can get a hip that works, would be a real benefit. And I don't know if there's a way if there's a trial period that you can see if it's something you'd actually use, or if it would be.
Yeah, so I want to clarify, it's $250 per subscription, and I multiplied it times 12 people.
Oh, so it's the 3,000 is not per person?
No, it's $250 per person for an annual subscription.
Oh my goodness, yeah, no, that would certainly be beneficial.
And so it could, $3,000 was, it would cover every board member plus Doris plus Robert.
I would like to support the suggestion that we get Morningstar for everybody. I've used Morningstar for 50 years, and it's delightfully complicated and simple at the same time.
Sounds.
I'd like to make a comment about it. I am on. Can you hear me? Okay, sorry, because I did have it turned on. Anyway, I do support or certainly understand Trustee Sturdy's comment about some of the investment reps at some of the conferences. I would like to point out that that's one of the reasons I really like the Calipers events, is their system staff and trustees only. There are no salespeople, no investment consultants or managers there. So that's a nice environment where you're just really interacting with other trustees or other staff, and they do a large amount of training on a number of wonderful topics. So I would encourage you to take advantage of the Calipers Roundtable. They have one specific for trustees, one specific for attorneys and for accountants, and you can choose to attend some of those roundtable trainings. They're a great opportunity to do so. As far as the Morningstar, we have a trustee education and travel policy that outlines essentially items that we spend or can spend money on. This type of subscription isn't specifically listed, so we wanted to have a discussion today, because if there's interest in it, we might need to modify the policy to allow us to offer something like that. The second item regarding Morningstar is Robert did reach out to them to see if we could establish a essentially a group user where MSARA is the administrator, so we could add and subtract authorized users as people transition on and off the board, and we were told, no, they don't have that option available to us. They would all be individual subscriptions that you essentially would own and we would not have any control over. So that brought up an issue about whether there were other providers for services similar to Morningstar where maybe MSARA could have an administrative role to allow us to add and remove people, or offering it where the system potentially would reimburse a trustee who wishes to buy their own membership on a yearly basis. A number of the systems do reimbursement for certain types of periodical subscriptions. I did check with the other 37 Act systems, and none of them actually offer a subscription like this to their board members, but they do reimbursements for certain periodical subscriptions, the Wall Street Journal and things of that nature.
Is there any further discussion on Morningstar or?
Madam Chair, I do have a concern if we're going to sign a 2-year contract to get the discount, that account will only be tied to a certain trustee. I don't think that's prudent, that if that trustee is no longer on the board, they would have access to something that was purchased by the board. So I don't know.
Is that a 1-year subscription, Dan?
Yeah.
So it's $250
So
per year?
I've already paid for myself. I won't be getting.
Yeah. It said in the recommendation, staff would like to sign a 2-year contract with the database software and would save around 2%.
Oh, now that is a completely separate thing.
Okay.
That is
right.
not what we're talking about. So that's actually the reason why staff wouldn't need a Morningstar subscription. We've got more robust software.
Okay. So that's the other software.
Yeah,
It's all in the same
so
paragraph.
that is separate, but that is going to essentially lock us in for 2 years. There's a small savings. I personally find it incredibly helpful, and prevents me from having to track individual manager exposures and fund holdings. I mean, it's incredibly helpful for me personally. So that is a separate item from a trustee subscription to Morningstar. It's not the same service even.
Right, and the level of detail is different between those two subscriptions. The one available to Robert as an institutional investor differs than the one available to individuals a little bit.
Understood.
So again, my thought is MSARA pays for board members to travel to conferences, and I'm sure we're all getting something out of those conferences. A board member then could go off the board, but they still took away whatever they took away from that conference. I don't see the harm in MSARA reimbursing a board member for a 1-year subscription to Morningstar at $250.
Yeah, I'm not opposed to the measure. I just wanted to let you know that we might need to either tweak our policy, and that because there's not an administrative role that we could play, we would just be doing a reimbursement rather than administering it.
Yeah, I would agree. It's not an issue of the dollar value. It's more an issue of what process are we going to use, and we have to update essentially our policy.
Just to continue this, it's in statute of the 37 Act that we have to put in 24 hours of board education every 2 years. And we write an evaluation and short summary for each hour that we spend at a conference. It would be personally helpful for me, if I stay on the board, to have a 2-year subscription and know that I'd have access to this resource. If I wrote up an hour on our regular sheets and turned it in, hopefully that would suffice for the 24 hours we're required to put in a 2-year period of time. So I'm just saying that would be personally useful for me at this age and stage in my life.
I think it depends on that time it was me. I do think it depends on how you would use Morningstar, but you probably could read some articles or other things and then write up a trustee education report on that for credit. Since we're on the topic of trustee education, it is important that the trustees complete their 24 hours every 2 years. It does look like some people have struggled with that. And you don't have to go to in-person conferences. There are a lot of webinars and other items available to you if you, should all be receiving the emails, and they're in, there's lists in the board packets quarterly at least with some of the trustee education items of opportunities that are out there. Callan and Siegel and some of our other vendors have some of those on-demand webinars, and I would encourage you to take advantage of it. It is important because it is a requirement of the law that you do 24 hours every 2 years.
I'd love to comment on that. So just last month, we presented you with a quarterly training report. In that report, I provide you with a link to the online reporting tool so that you can actually click that link and you can report electronically. If you do an online training, you maybe read an interesting presentation on investment, check Morningstar, and I do give you credit for those hours that you claim that you spent that time studying that topic. We have Callan on-demand webinars, Callan Research Library. Siegel Company has on-demand webinars. NC PERS is a new item on the list. They have a center for online learning. And in those reports that are posted on the SharePoint and on our website, those reports include embedded links. So all you have to do is click on the link. It'll take you to the page. You can choose the information that you wish to research, review, read. And then you just need to do your electronic reporting form. Credit. You can do all of that on your iPads or from your personal computer. You don't need to have a special county.
And we'll still take a paper form for those of you who may not want to use the electronic reporting link, but it is very convenient, I'm told.
Yes.
Isn't that right, Trustee Cromer?
It is.
Thanks.
Do we need action on this item, Madam Chair, or is it, it's a
I would
preliminary?
defer to council on that. I'm not
This
sure.
is an action item in that you need to adopt the budget.
No. I was just talking about morning.
That would be helpful. That could be direction to staff. We can probably accommodate that cost within the $74,000 that's already budgeted. I don't think we would need to do an amendment to increase the amount budgeted for next year for that if you'd like to include it. So you could just simply, in the motion to adopt the budget, specify if it includes reimbursement of the trustees' cost to obtain a Morningstar subscription. Would that work?
Yeah, so I would move to approve the recommended budget with direction of staff to reimburse board members for an annual subscription to Morningstar. And for the record, I won't be seeking reimbursement. I've already paid. I said, for the record, I won't be seeking personal reimbursement because I've already paid for Morningstar. I'm not. That's not why I'm proposing this.
I'll second.
Okay. Is there any discussion on the motion? Is there any public comment?
I sort of have
sorry.
one other, no, I just wanted to sort of mention if we're approving the budget.
Yes.
Right. So one other comment that I think sort of goes to the whole training aspect is staff go to multiple conferences a year. And I would love to see some trustees at those conferences. I would enjoy being able to sit through some of these discussions that are had and chat about, you know, your takeaways, my takeaway, what's best for Sarah. So I would encourage trustees to attempt to plan and make some of those conferences in the future. November Sackers, let's go.
I just attended the Spring Sackers, and I have to admit, I think this one was the best conference in the last several that I had attended. The topics were were timely and engaging. They had good presenters. So it is a valuable resource out there. In addition to the prepared keynote speakers, they have breakout and concurrent sessions where you get to go into smaller groups and focus on a specific topic. And I would encourage you to take advantage of those or the calipers trainings.
Is there any public comment, Judy?
There is no public comment.
Okay, would you please do a roll call vote?
Yes. Mr. Kelly?
Aye.
Ms. Cavness?
Yes.
Mr. Jurdy?
Yes.
Mr. Cromer?
Aye.
Ms. Harris?
Aye.
Mr. Swope?
Aye.
Ms. Pierce?
Aye.
Mr. Land?
Yes.
Approved.
Okay. On to item 6, discussion and possible action regarding contract with contractor for Kings Court Americans with Disabilities Improvements. Director Rentschler.
Thank you, Chair Cavness. In the board packet is the contract with the firm who received the low bid, Kirby Construction, to perform the ADA modification work at our Kings Court location. The contract is 162 pages. It's a little long, but it's primarily consists of a document where we requested bidders for the request for bids because it explained what they needed to do, and it also includes the addendums to that. So it is lengthy, but the first couple of pages are where we would have signatures from Chair Cavness and myself and Kirby Construction. The bid itself came in at $473,425. We did have only 2 bids received, and Kirby Construction was the low bid. If you have any questions regarding the project, I'd be happy to answer any questions at this time. Oh,
Trustee Harris?
Mr. Swope.
Just out of curiosity, you were satisfied with the history of this firm, as in successful completion?
Kirby Construction has done other work for the County of Mendocino. They did have good references and results of similar types of products. The architect who assisted with not only drafting the plans, but drafting of the request for bid packet was familiar with them, and he had no reservations.
Thank you.
Is there any discussion on the item?
Madam Chair, I know that many construction companies are busy beyond their own abilities. Is there a timeline from Kirby as to when they could begin work if this is approved?
Once we have issued the notice to proceed, which is contingent upon 2 things, getting a signed contract and also having the permits issued by the city of Ukiah, and the architectural plans are under review at the city. They've come back a second time with some additional changes or questions regarding the plans. But once we get the permits issued, we'll issue a notice to proceed date, which would provide 150 days for completion of the project at that point in time.
Thank you.
Any further discussion? Do we have a motion?
Madam Chair, I'll move to approve the contract as proposed.
Is there a second? Is there any further, is there a second?
Second?
Is there any further discussion? Is there any public comment?
There's no public comment.
Ms. Zeller, would you please take a roll call vote?
Mr. Kelly?
Aye.
Ms. Cavness?
Aye.
Mr. Jurdy?
Yes.
Cromer?
Aye.
Ms. Harris? Mr. Swope?
Aye.
Ms. Pierce?
Yes.
And Mr. Land?
Aye.
Approved.
Okay, discussion regarding well, excuse me, this administrative report, Director Rentschler.
As an update to information provided at the March meeting, the California Supreme Court did grant review of the Ventura County Employees Retirement Association versus the, forget what that stands for. I believe it's perhaps their judges, the CJAAVAC. If the lower court ruling is reversed, MSERA could be required to alter the manner in which it handled leave cash-out payments that exceeded the amount permitted in a year. It's called the straddling issue that we already corrected as part of our Alameda corrections. Attorneys for VSERA are asking other SERL systems to consider submitting an amicus brief to the court, and briefs would be due by August 7th. Staff recommends that MSERA file an amicus brief or sign on to a joint brief with other SERL systems and seeks board direction. Council may have comment on this.
Achieve the goal of showing support without having much cost. The other thing I'll mention, and it was discussed at the Stackers meeting at the roundtable, fingers crossed, the only reason that the California Supreme Court is taking the case up, hopefully, is to say, hey, we've really decided this issue, stop bringing these actions. Fingers crossed.
Thank you. There's a pension gold update in the memo in your packets, and I would like to announce that we've actually offered a position for a retirement specialist, and Michael will be starting on May 26th, I believe. I'm sorry, 28th. So we have one of the two vacant positions filled now.
Is there any discussion on the administrative report? Is there any public comment?
There's no public comment.
Okay, so we are at general board member discussion. Is there any general board member discussion? Okay, seeing none, we're going to move into closed session, and room B for the following. Non-service connected disability application, Rhonda Baker, Program Specialist 2, pursuant to Government Code Section 54957B. Okay, both, all right. Public Employee Performance Evaluation, Executive Director, pursuant to Government Code Section 54957. And so, we're going to go into closed session.
Okay, on item 9A, the board met in closed session and voted unanimously to grant Rhonda Baker a non-service retirement, and the board met in closed session on 9B and had some preliminary discussions on the executive director's.
Okay, thank you. Okay, and the audit committee will be meeting today at, after, what? Oh, yes, at 1 p.m. at 625B Kings Court. And the next regularly scheduled Board of Retirement meeting will be June 19th at 8:30 a.m. And so this meeting is adjourned at 11:28. Thank you.